Howdy, everybody. This is Darius Dell here welcome to our edition of the Macro Q&A, Macro Bundle Q&A rather. I am joined with my good friend Larry Baxter, global macro investor. How you doing today, Larry?
I'm doing very good, Darius. True pleasure to be on here today.
It is a pleasure to have you, man. You have one of the more interesting backgrounds of anyone I've met in this industry, really in life. So I'd love to hear a little bit about it, present that to our audience, and we'll take it from there.
Oh, thank you. It's been all over the place. I was trained as a chemical and biomedical engineer, and did actually put that into practice, mathematical modeling toward cancer delivery. I was on the faculty at Harvard Medical School for quite a few years. Then shifted into industry, did some more mathematical modeling, a lot of software development, and really continued with the theme of optimization and being data driven in my approach. Later on, switched on to kind of a very much a change of track over to ministry, and right now I'm the chief operating officer of a nonprofit ministry, and having a lot of fun with that as well.
That is awesome, man. So you're a math guy, you're a data geek guy as well. So I assume that's probably one of the reasons you've been drawn to our service. So we appreciate that.
Absolutely.
Thank yeah, no, thank you. It's look, it's a labor of love, as I like to say. So talk to me about how you implement some of the data that we're producing. As you know, we produce a lot of content. Some of it's very geared towards the institutional audience. Some of it's geared towards the retail audience. How do you implement what are the best things you see from us, and how do you implement that into your investments?
Well, that's a great question. I really wasn't even aware of what global macro investing was about a year and a half ago, and I was very thankful to get a strong introduction to that, and had to just dive into mass research mode, kind of a professional researcher, and the approach that 42 macro takes is unique and for me very very valuable. Having done math modeling and knowing calculus and statistics very well, I can tell when someone knows their stuff and when someone doesn't. Let's just leave it to say that you, my friend, know your stuff, and I can trust the modeling and the data and the care with which you put together your model. That's important to me because I'm very data driven, and the model and the assumptions in the model are super important to me. That's a key reason why 42 macro is good for me. Now, as I am kind of getting older, not too far away from retirement, the other key thing is I want to ride this bull market, and there's always a bull market somewhere. I want to ride that as long as I can, but I really have to watch for minimizing drawdowns at this point. So that's another great fit for your process and the overall approach that you take with that. And so for me, the weekly and the core portfolio is important for my timing. I have a full time job. I want to have a balanced portfolio with minimal drawdowns, and so the weekly adjustment to the portfolio is perfect for the main portion of my portfolio. I do have some speculations. I'm much higher into crypto, and at certain points things like uranium or coal or carbon credits, and so the monthly scouting report helps me to understand what's the macro landscape, keeps me an eye for transitions that might be coming. The overall tenure, is it more risk on or off? And those
Mhm.
risk reward plots by grid, that's golden. I use that as a curated watch list, and those are the things that I'm going to be watching more closely with my limited time. And those are the things that I may choose to use options for, kind of add a long volatility component. And so the daily morning note gives me my playbook for the day, my compass. What are the things
Mhm.
to watch out for? And the VAM signals, along with that curated watch list, give me an eye to having more confidence in the things that I'm going to be putting positions on. And so, calls on uranium, natural gas have worked out extremely well, while at the same time minimizing the risk on the table with that. And then also, finally, I love the fact you're active on Twitter. You engage with your community there. It feels like a team experience there, and the into the close tweets get me out of Dodge. that has literally saved me and my family multiple thousands of dollars. And to have that before the fact, before the close, is absolutely golden. And so the fact that you are data driven and you are putting in massive hours doing that daily grind means I don't have to. I can spend my time on my job, my family, and invest with them in competence. So that's overall how I utilize the 42 macro process as part of my own process.
Yeah, man. And one, thank you so much for the kind words. I appreciate that. It takes a math guy to know a math guy, I guess, is what you're saying. Again, I appreciate the really humble, or I'm very humbled by your kind words on that. You hit on something that is really interesting. It's funny. Global macro investor might be actually be too small of a title for you. You're almost like a global macro portfolio manager, because in terms of how you engage with the process, it sounds like I'm talking to a PM. I mean, like when I'm on my client Zooms, the Proto Pro Zooms every week, throughout the week, it's, we go to those scatter plots almost in the first, quarter of the call every single time. Okay, what is the risk reward setup? Because that's how professional investors invest. It's not necessarily about forecasting the direction of the market. It's about the dispersion within the market, within the context of the asset class or the asset classes those investors can transact in. Obviously, you as a retail investor or a part-time global macro PM can go anywhere. And I think that a lot of investors watching us today, and again, we appreciate all you guys for joining us. A lot of investors can go anywhere. And so what we're trying to do is sort of help investors with all the data that we produce, shrink the distribution of probable outcomes, or at least make it more manageable. Because when you wake up as an investor, let's say you didn't have any of the data that we're producing or any of this stuff, you're drinking from a fire hose with respect to the amount of information that is being produced on Twitter. Some of it's good, some of it's bad. There's just a lot of information out there. So how do you know whether or not, okay, I should actually be, this is a great opportunity or market regime to be buying uranium calls in, or, to be selling, the VIX, selling volatility in, or things of that nature. And so that's what we're trying to do, is help investors understand the distribution of probable outcomes. I think it'd be easier, and we'd probably have more subscribers if I just said, hey, go do this, and wake up and tell you to go do XYZ one day. But that's not what we're trying to build here. What we're trying to build here is an empowerment service that allows investors like you to check in for 30 minutes a day, or 15 to 30 minutes a day, and actually get all the information they need to be empowered by the information, as opposed to being told what to do. We are not here to tell anybody what to do. We're here to augment your returns. So I appreciate you saying all that. In terms of let's getting in, transitioning to the current setup, the market setup. What's top of mind for you in terms of the economic data, or in terms of the market outlook, that you want to kind of hit on before we have to turn it over to questions?
The that really the key concern on my mind is, how long is the continued bull market in several asset classes going to continue, and
Mm-hmm.
what really are the signs to watch for. Your four horsemen, the ratios are so critical for that. For me as a Bitcoin investor, buying the thesis of it heading to 100K possibly by end of a year, but not marrying that proposition. And I wrote it down. I wrote it down from 60. I'll be honest. And so knowing what are going to be the signals that indicate stronger the potential for going down. Not a bold. I'm calling the top here, but as someone who's done statistical modeling, I totally get the probabilistic nature of that, and the stochastic returns that we receive. But for me, getting a handle on how will we know when it's time to pull the funds out, and let's see how there's so many guesses on what's going to happen to inflation. I can't keep up with them, and B, y'all are much smarter than me in that. I'm a retail guy, and so I can't even try to figure that out. But knowing when it's positioning that, hey, this is a warning sign. That's what's key. That's what's key for me. And one of the questions I see you're asking from Brad, how does that VVIX to VIX ratio help, or the other kind of the other horsemen that you look at critically for pointing out when things might be heading south?
Yeah, that great question. So, yeah, a lot in there. Let me sort of break it down into its component parts. I think the the number one question you're really asking is, okay, what set of indicators or tools that you're producing currently, that you're updating daily, that'll give us the best read or the cleanest read on when to get out or when to take down our overall exposure to something like the equity market or the cryptocurrency market. And I think, with respect to the leading edge of our process, which is market based, the market regime signaling process, and our volatility adjusted momentum signals, those are the leading edges in terms of saying, hey, the environment has changed. The conditions have changed. Now Michael Guyette talks about this. The conditions are now favoring an accident. And so I would say the first, with respect to our four horsemen of market risk, and I detailed this in yesterday's macro scouting report for those of you who haven't had a chance to check that out. The reason we sort of look at the world through this lens in terms of this being the leading edge of our market and signaling process is because if your goal is to minimize drawdowns, you want to use things that are really good at signaling drawdowns on a prospective basis. And so these four ratios, the VVIX-VIX ratio, and I'll explain why we look at the VVIX-VIX ratio in a second. The VVIX-VIX ratio, the high beta, low beta ratio, which itself is the volatility adjustment, is high yield OAS. So clearly, if high yield OAS is breaking out and this is breaking down in price, that's a very clear risk off signal for investors to be aware of. Same thing with small cap, mega cap ratio. The volatility adjustment for this is the dollar index, the Bloomberg dollar index. And so to the extent you're seeing a stronger dollar, it's indicative of tighter liquidity conditions. And obviously, if this is going down in price, that's really negative. And then lastly, with here on slide 18, the value to growth ratio, that's the volatility adjustment for that feature is the CCC OAS. So even further out on the risk curve with respect to credit spread risk. And so if you obviously have a blowout in credit spreads and a breakdown in price here, you're talking about something that's changed relative to a bull market. And so whenever you get the value to growth ratio, the small cap to mega cap ratio, the high beta to low beta ratio, and then the VVIX-VIX ratio, all bearish, it's telling you that you're having a market event. I don't care how bullish you are from a fundamental perspective. You need to do something else with respect to your investments. Take down your overall exposure to the market, raise cash, buy I like to call them anti-beta assets, things like treasury bonds, volatility, stuff like that. The dollar itself is an anti-beta asset. Gold tends to be an asset like that as well. That's when you need to do something different from a portfolio construction perspective. And then lastly, explaining Brad's question, the reason the VVIX-VIX ratio, so what we're really trying to do here is put boundaries around sort of volatility, the volatility regime. Because obviously, if you're just looking at the VIX, it's a non-stationary time series for the most part. And so it's, it can just go lower and lower and lower, and you don't really have any idea of, okay, when is it too low? And so what we're doing here is looking at the relationship between the volatility and volatility itself. And what that typically means when this is breaking down, it means investors are actually buying VIX futures themselves. They're buying into the VIX, this near-term sort of protection relative to calls on the VIX or puts on the VIX or things of that nature. It's indicative of investors actually reaching for near-term protection in a very sort of aggressive manner. And that's why you typically see this thing sell off in market corrections. So it's bullish now, as is the high beta, low beta ratio. This is bearish still. This is bearish still. So it's not, this is not, as I mentioned, I've said this 1,000 times, this mini reflation trade that we're observing right now is not the same reflation trade that we saw, in this sort of November through June period where you saw all four of these ratios just resoundingly bullish. The economic environment doesn't necessarily support that.
Do you find that the VVIX ratio and the other ones are a good leading indicator for potential impending corrections, or they just correlate well once the correction has occurred?
No, I find that they're leading indicators. So if you look at the charts, they tend to transition to bearish before the broader market moves. I mean, it's usually the market is already starting to move and correct. But when you're talking about a big market drawdown, something like that looks like this, the VVIX-VIX ratio is probably bearish here, high beta, low beta ratio. All these other ratios, they're turning bearish into this big move that we're all trying to avoid with our hard-earned money, our hard-earned capital. So yes, that's why we feature them in the process as standalone, sort of secondary checks with respect to the broader market regime nowcasting process. I mean, the reality is, you could sell every stock in the world on this. I believe this transition to deflation on February 10th, and very clearly, very strong showing with respect to how obvious that was. When this has obviously been talking about grid zero for a while now. Like this is nothing's obvious here with respect to the market regime nowcasting process. This transition to deflation was very obvious, and so that in of itself is a signal that you, at the bare minimum, you need to pivot to a deflation portfolio construction. Whether or not you pivot to a deflation portfolio construction with an elevated amount of cash is a secondary consideration, and I would argue that's where you start to layer on these sort of four horsemen of market risk as that secondary consideration.
Yeah. One of the other kind of key things I really wonder, and I get very competing answers for the individual assets that you hold, especially the ones that have been ripping. How do you know when to get out of that? Because normally when they start, when they hit the top, you say add protection, or you could also trim a little bit, by a put. Um, when they're coming back down, though, how do you know, or how do you act upon the possibility of them, just really going into a bearish trend? What's the data or signal that you're looking for a breakout trend? Because if something has gone up quite considerably, if you wait for it to come back to trend, or to go bearish, you could lose all your gains on that. So how do you know how to get out of an individual position before it's too late?
Yeah, no, that's a great question. I think that's I'll start by saying I don't think there is a correct answer. I think there's a million ways to skin that cat. In terms of how we think about skinning that cat, for us, it's about understanding what the likely evolution is of this process, of the market regime nowcasting process. If for example, going back to our grid zero portfolio construction, let's say we have something like nat gas would be a perfect example of that. I would argue base metals is another example of something like that, or not has gone up a lot, but certainly something that looks like it might be on its way to transitioning to bearish. So we'll highlight these two particular exposures. If we start to think either, if we start to observe both in the market regime nowcasting process, but also if we actually start to observe data that tells me as the human investor at the intersection of the data and our human intuition, it tells me that, hey, the market is no longer going to overpay for these types of exposures, then we need to start to think about reducing that risk. And so, for example, I think one of the things that's weighed on pure commodity speculation in the most recent weeks is the fact that we've seen a breakdown, or we haven't seen the full breakdown in advanced terms, but we've certainly seen a pretty decent move off the lower high in bond yields that we've just observed in the last month or so. And so, to me, I think that's the market saying, hey, as hot as today's inflation data was, and hot as yesterday's PPI data was, the bond market is looking ahead into the next few months and the next year and saying, hey, inflation is going to be lower. And so the probability that there are certain investors who are going to have to, at the bare minimum, rebalance into bonds heading into next year, but moreover, at the bare maximum, think bonds might actually be an attractive opportunity at certain rates on the 10-year, because don't forget, we're still competing with Japan, Europe, and all these other sovereign bond yields that are much lower than ours. There's a contingency of investors that might say, hey, our allocation to this red pie is too high. We need to increase our allocation to that, to a dark blue pie, and so, or to a dark blue slice of the pie. And so it's in terms of understanding, okay, when to sell things and book gains. The reality is, if you're in a raging bull market, you don't want to be doing that too often. But if this is a perfect example. If the environment might not favor taking incremental risk. If anything, it might start to favor taking less risk with respect to pure commodity exposures. So that's something that, this is a perfect example right now of how to answer that question, which is, look, the macro environment is going to dictate how much risk I want to take in any one of these slices of the pies. And at the very minimum, something that's at the upper boundary of its probable range will be a candidate to reduce our exposure to, in so much that if I really start to believe that one of these slices should be materially reduced as a function, again, of the market regime nowcasting process or the evolution of the data, then we'll just start to have to sell things anyway. So that's an excellent question, Larry. I appreciate that.
Now, with the advent of the ETFs for Bitcoin, and we're hitting another all-time high today. If folks do want to ape into that, so to speak, or increase their exposure, are there specific ways that you're making use of those ETFs or options, or what other thoughts do you have with respect on how to play crypto at this point?
I would be the one of the worst people in the world to answer that. Thankfully, we had Omar Sebek, a friend of mine who runs Sasco Digital, on last week. access. If you don't have that replay link in your inbox, just shoot us an email, or hit us up on Twitter. We'll make sure you guys have that, or it might actually just be on the site. Anyway, but yeah, so for the execution of Bitcoin, things of that nature, I'm certainly not going to be the best source on that. But I do believe that, look, the GBTC has a high expense ratio, but the reality is if you're long this thing and it's up 20, 30, 40, 50%, you stop caring about the expense ratio. You know what I mean? And so I think that's sort of the case. That's been my view on it. And as obviously, grinding through data all day, I personally don't have a lot of time to trade. So I tend to want to simplify things as well.
Out to
Oh
others
yeah.
on Team 42 that we can look to. That's great.
Yeah, no, and again, if I don't know the answer, one, I'll tell you, but two, I'll start working on trying to find the answer. And working on trying to find the answer, there's really no point in me doing that when I can just point you to a better source, someone who actually runs a firm that I trust in terms of helping investors find that solution.
Hmm. So with the big CPI numbers this
Yeah,
morning, how are you looking to play this week?
yeah. So let's take it to the chart, because today we got some very hot numbers. So going back to the last kind of like 4 or 5 months, what we've seen is a consistent, persistent deceleration of CPI momentum, the sequential momentum of the time series. And I've been saying, hey, look, ignore the year-over-year prints. It's mostly noise, because we're seeing the momentum decelerate. Well, that stopped in October. That's a very big sort of forecast error, not forecast error, because I wasn't trying to forecast this, but it is new. We had seen CPI momentum go from basically 11%, a little bit over 11%, at the highs of June or July, and kind of gone down to 1 to 2%, which was telling you, hey, look, these year-over-year sticks are going to be much lower in a year. However, this is new, and it's unclear whether or not, okay, this is a one. Is this a one-off? Is this Delta? Is this supply chains trying to get ahead of the Christmas wave? I don't know what the answer to that is, but we certainly know that if this keeps up, we're not going to see the disinflation that we have projected over the next 12 months. So again, I don't expect it to keep up. It's very unlikely we sustain an 11.9% annualized pace of inflation from here. It's almost impossible, considering the fact that we barely were able to sustain it with a record amount of fiscal stimulus and a record reopening impulse that we no longer have. We're reopening is a rearview mirror exercise now. So I expect, kind of sitting in the chair and gone through a bunch of cycles on inflation and growth, I expect this to be the peak in terms of the impulse and the momentum. But what that really means is that in terms of the deceleration we're likely to see in CPI, one, it starts later in terms of the deceleration. So I haven't had a chance to update all the charts in the model. I've been updating the model prior to this, but the deceleration will start later and it will be less severe. And so that is the key takeaway in terms of what that momentum signal means. But it doesn't necessarily mean that we're going to do this. Doing this is what makes you choose something different from a portfolio construction perspective. This, taking an additional month and then doing that, is more or less in line with our expectations anyway. The one thing I will say on that, and we still, again, we're in the process of updating all the models as well. If we start to see inflation bite into economic activity when we start to get the hard data for October, because the soft data for October would make slightly better, certainly better than what they were in September. If we start to get the hard data for October and it looks like this sequential inflation momentum is really taking a bite out of growth, to the extent that we're not going to be able to meet those lofty Q4 growth expectations that that are currently sort of out there in the market. You got around 5-6% for Bloomberg consensus. You're 7-8% for Atlanta Fed. If the market starts to get concerned about that, then you're going to start to see some more breakdown in those four horseman ratios that we talked about earlier. So, fluid situation, man. It's like I said, the range of probable outcomes in Q4 is extremely wide. It was never going to be like, oh my God, this obvious reflation, both economically or financial market wise. And I think that's exactly what we got. And we have to just accept the fact that, look, hopefully you made a ton of money from November to June. Like I said, I assume most people watching sort of heard me say, look, there's going to be a historic inflation trade. Everything's going to go up a lot. I said that in early November of last year. And now it's November of this year. And November of this year is a very different economic environment. We don't have record monetary easing ahead of us. We don't have record fiscal stimulus ahead of us. We don't have a record reopening impulse ahead of us. So the reality is, I don't want to go so far as to say the market is skating on thin ice, but it's certainly skating on thinner ice than it was, in that prior reflation trade. And so that's
Yeah.
it. Just we don't have the headroom for a material disappointment economically in terms of keeping the market elevated and keeping investor flows chasing this thing higher. So
Okay.
definitely a cause for concern as it relates to our overall construction. But we're obviously keeping our eye on the ball here.
Hmm. One of the questions I get from from other retail investors is right now within the portfolio construction process, there's an equal allocation, kind of 4% across the board for that. Given the great uncertainties, is there any benefit, or how would people implement a variable allocation approach, or is the fact that you have an allocation for each of the four quadrants, does that allow you to take on some of these more volatile assets, the Bitcoin, natural gas, uranium, um, while having the safety net in the reflation, or sorry, the deflation part of the grid, and that's why you prefer to keep those higher.
No, it's a great question. I would argue it's having the allocation to each of the four grid regimes is what allows us to take more risk, because take ignore the fact that we're data driven investors and we actually have a process to get to us into what the colors on this page are indicating here on slide 23. A lot of investors are narrative based investors. In fact, so
Mhm.
they go into it's Goldilocks, their whole portfolio looks like green, or it's reflation, their whole portfolio looks like reflation, or it's vice versa, or it's inflation or deflation. The reality is, because the distribution of probable outcomes is as narrow as it is economically, each one of these narrative based investors is going to be right, and they're going to flow assets into the assets that most correspond to those belief systems. And so you're effectively allowing yourself to take advantage of the fact that every Tom, Dick, and Harry, T, D, and H, Tom, Dick, Harry, and let's call him Wyatt. I don't know why I got Wyatt from, but Tom, Dick, Harry, and Wyatt are all going to go buy things that tell them that they're the smartest investors in the world because they're nailing it on inflation. They're no, it's deflation. What's my man Stephen Van Meter, good friend now. He's firmly in the deflation camp. I'm sure he's seeing plenty of data that's telling him deflation's coming. So all these investors, that's the whole point of doing the math. All these investors are going to get something that allows them to feel comfortable about their asset allocation. And so we want to take advantage of them all chasing those views. And that's the whole point purpose of the grid zero portfolio construction. So I would argue it's not a defensive portfolio construction by any stretch of the imagination. We're actually trying to take advantage of the fact that everybody's going to be chasing assets in every which way direction.
Right. Well, when like I resonate strongly with that answer, and that's kind of what I was guessing for them. But I did say I would check on that today. My past month has been the best all year, hands down. And
Wow.
I tell people that about a quarter of my portfolio was in bonds. I had at that point about 20% cash, and I'm making 10-20% per month. And they're looking at me like, how on earth do you do that? It's by making the bets when the data suggests it's the right time to do that, but
Mm-hmm.
not being so arrogant that you're using leverage, or going doubling down on a narrative that you think that you're right. I didn't think I'm right. It wouldn't surprise me to see the grid going any direction. But if the signals and the data are suggesting this is where to put it, then I'm going to put it there. So thanks for that. Appreciate that. You know what you do makes a big difference to the retail investor. This is my family, my retirement, my kids, my legacy. I want to give away a lot as well, and so the ability to invest with confidence and not just go to a 60-40 old man's portfolio is very important to me. So again, thanks for doing that.
I appreciate it, man. Thank you. And look, there's going to be a time when we look like we have a 60-40 portfolio. It's not going to be because we think 60-40 is the best solution. It's because we think that this is the economic environment is dictating we do. And that's
Right.
that's the whole point of the process. It's that it's interval proof. At any point in time, based on the impulses between growth and inflation and the intersection of policy, in terms of reacting to those two, the changes in those two variables, you're going to have an appropriate asset allocation that is designed to outperform in that environment. Now, the
Right.
challenge is understanding, to the purpose of the penultimate question, the challenge is understanding when might the environment start to change, and when to book gains, or when to start to rotate into things
Right.
that are maybe beneficial with respect to the next environment. So that's what we're doing all the incremental data from. That's like you said earlier, that's what the macro scouting report is for. Like around the horn is saying, hey, it's raining today or it's sunny today, put these clothes on, right? Or I might spend a little bit of time talking about how the weather might evolve. But the reality is, if you really want to understand like what I really think about, okay, the next 6 months, 9 months, where should I really be thinking about building core positions? That's where all that data is for. That's where that data is presented.
Right. One a question in chat here is why would someone put money into bonds when there's negative real rates? That's a hard thing for folks to do. I think I know your answer, but how would you address that one?
Well, it's two reasons: capital appreciation and inverse covariance. I mean, so you guys have know one, bonds are doing really well in the last month. So let's start there. It's not about collecting, because I don't intend to hold a 25 or 30-year treasury coupon to maturity. We'll probably have traded it several hundred times, or not several thousand times, between now and 30 years from now. And the reality is, what we're trying to do is take advantage of the capital depreciation associated with yields going down from whatever place you put the trade on. I certainly, again, we have no intention of holding any of these assets to maturity. So the real rate is really not it's not the issue. And more importantly, I've done a lot of work in this portfolio, or in this November macro scouting report. I think it's on slide 50. If I can memorize my new slides here, on slide 56 here. We're talking about is the covariance, the inverse covariance between stocks and bonds is really important, because again, you're talking about having something. We haven't really had any real down days in stocks in 6 weeks, but back in time, there was a time where you were getting down days in stocks, and you still see that inverse correlation, particularly over the last couple of weeks, even though the down days in stocks have been small. But this chart here, I did a lot of work on unpacking the secular inflation dynamics, and kind of the key takeaway on that work, the previous sort of 15 slides or so, which is that based on our analysis, the stationary mean for CPI has already transposed itself roughly 80 basis points higher. And so roughly the 10-year break even, which is currently priced around 2.6%, is roughly around where inflation should average over the next decade. So ESG is a wild card on that front. The dollar and commodities are a wild card on that front. I wouldn't put them in a model because they're too variable. But the reality is, you're talking about at least an average of 2.6% CPI over the next decade, which is up from around 1.8% in the 2010 to 2019 decade. That's not going to get you to a positive correlation between stocks and bonds. On this chart here shows the covariance between the long bond relative to the Dow Jones Industrial Average on a rolling 2-year basis. And, back in the 70s and all the way through the late 90s, it was a positive 40% correlation. But you had inflation averaging, basically 5% throughout that time horizon. I just said all the work that we've done, through all the different tools that we have available in our toolkit are telling us that inflation at the highest is going to, or not the highest, sorry, inflation is going to average somewhere around 2.6% over the next decade. And so that's, to me, that's not indicative of an environment where the inverse correlation between stocks and bonds is going to dissipate. So that's part of the answer to answer the question. That's the long-winded answer of, okay, I still believe in the inverse correlation between stocks and bonds, because I do believe there's a lot of conjecture out there, narrative-based conjecture out there on Twitter and in other sources around that relationship.
Okay. There's a question in chat here that reflects the question I get from non-macro-aware investors, and that is, do you have any idea or aware of what research, what percent of the asset price variation is explained by rates of change differences in growth and inflation?
I think I can let me spend some time on that and get back next week on that one, because that's a great question. I have to think about how to answer that. And it's really not even, to be quite honest, I don't think asset price variation is the actual thing you want to be looking for. What you actually, what you're looking for is asset price dispersion. Now, it will explain a tremendous amount of dispersion. When I construct the grid asset market back test, or some pretty famous back tests in my prior shop, what you notice when the back test, so this is how you know if your regime segmentation process is working. Do you have limited dispersion within the regime? And do you have a decent amount of dispersion across regimes? That's what you want in a regime segmentation process. And very consistently, when you construct these back tests using monthly data, using quarterly data, using different time horizons, 25 years, 30 years, 50 years, it all says the same thing, that you want to be defensive here, or defensive on this side of the chart, offensive on this side of the chart, and you want to be taking disinflationary stock risks on, when you're in Goldilocks and deflation, and you want to be inflationary style risks when you're in one of these two. It's pretty consistent across
Mhm.
times. There's obviously idiosyncrasies both within our own markets in the U.S., but also across geographies as well. But to answer your question is, that consistency across samples, the consistency across the duration of the sort of the duration of the variables that you're looking at, whether they be monthly or quarterly, that consistency means something. I don't believe that Ray Dalio would have built the world's biggest hedge fund on similar type frameworks if this stuff didn't work.
Right. Right. Hey, question on the dispersion graphs where you're looking at the top quintile, lower quintile, the sharp adjusted returns. When you see things at the top like Tesla right now and those type of things, are you looking to get trading ideas from that, or is that more of a read on what the market is, the fact that there is a big dispersion, more for awareness purposes, or are you actually looking to fade or get in on some of those in the upper quintile?
A very I almost got the identical question yesterday in a pro meeting. So outstanding question. So the answer is the short answer is no. We're not looking at this particular analysis to get trading signals. What I'm looking at this particular analysis for is to get a clue as to two clues. One, what does the market sort of, what side of this chart does the market really think we're on? Is it pricing in a defensive posture over here, or is it pricing in an offensive posture over here? And so, the answer is based on the composition of the sector and style factor, leadership, and laggardship. I'm not even sure if that's a word, but I'm going to make it up today. Between the composition, I can say, hey, the market is betting on at the margin, because this is month over month Sharpe ratios. I use that as a proxy for pot shop flows. The market is incrementally betting on this regime, or really Goldilocks or inflation or deflation. But more importantly, what I'm actually looking for is that changes. Is it changing? Because to me, this is as good as a leading indicator for the change in the market, overall market regime process, as anything. This composition is, go back to mid-September. We're saying, hey, look, the market is correcting, but I think the market is actually, it's telling you that we're pivoting towards reflation. Even though the market's going down in price, you see the composition go from, you went from a summertime full of, the composition of the lower quintile was consistently cyclical in terms of like the things that were lagging throughout the summertime. What became very pro-cyclical in terms of the things that were leading during the drawdown. And I said, hey, look, this is very similar to the drawdown we saw in October of 2020, where the market actually went down, but the dispersion, dispersion analysis was saying, hey, look, the cyclical sector and style factors are starting to lead. And obviously that was a pretty meaningful leading indicator for an explosive, reflation, a historic reflation trade, if you will. And so I think that was a very similar, use of the process in this term in terms of predicting the reflation trade that we're now engaged in. And so again, it's not necessarily looking at this process for individual trading signals, like I want to go buy this or short this or vice versa. It's how does this change over time, the composition change over time. And right now, as I mentioned in the most recent Around the Horn presentations, hey, look, it's fairly balanced. And again, that fairly balanced is, you got people buying all kind of stuff because again, Tom, Dick, Harry, and Wyatt all think they're right. And they're all getting data that's telling them they're right. And so like to me, that when we move out of that regime and one of them are likely to be right as the next big call, in our opinion, I still think that Wyatt is ultimately the next winner in terms of representing deflation.
Your answer here and to an earlier one show why this is kind of the thinking person's service for portfolio management. In both cases, you've identified things that are important in terms of understanding the overall risk on, risk off nature of the market, what it's doing, what change is looking to happen. Your earlier answer to the signals for when to get in and out of an individual asset, you answered that the overall temperature of the market is an important factor there. So many other people will look at that dispersion chart and they'll say, if you had been in Tesla for the past month, you'd be up 20%. If you've been in energy for the last 4 months, you'd be up 40%. That's absolutely useless to me. I want to know, what am I going to do today, and should I be considering, increasing my allocation in X or Y or not? I don't need people telling me what has been happening. So I really appreciate the the thoughtful way in which you're using these in a way very different from others, either momentum chasers or strict trend following systems. You don't fit neatly into those categories, and I can see why this is a bit of a head scratcher for some people to even understand your approach.
It's like two things. One, it's what we do is not for everybody. I make no bones about that. But it is for people who want to have who want to be empowered by data to make better investment decisions, consistently make better investment decisions. I mean, again, I've spent 12 and a half years now consulting with institutional investors on, what are the best things to do with respect to allocating across asset classes and overall constructing portfolio risk, and obviously using the rate of change of growth and inflation and the Fed's and Treasury's reaction function to those variables is obviously a really good leading indicator for some of the decisions that the investors have to make. But the reality is what we're really trying to do is consistently arm you with data that is forward looking. I think there's a lot of just a lot of color style research. Hey, this happened, XYZ, this happened. Well, that's great. It's great to know stuff, but it's not great. It's not helpful to know stuff if you're talking about actually having to put capital, put risk to work. And so, with respect to everything that we're producing here, 42 Macro, what we're really trying to do is help investors always know where the puck is coming, is about to go, or at least what we think the puck is about to go, or where the pass is about to be headed, or how the weather is likely to change. You don't see me spending a lot of time on what has happened. Most of the research we put out is with the expectation of, hey, I think this is going to happen, and it's changed at the margin based on this incremental signal or this incremental piece of data. And
Mm.
so thank you for calling that out. I appreciate you, Larry. I appreciate everyone for tuning in. We really thank you guys for all the questions and for tuning in, and we'll catch you back here next week, my friend.
Thank you. Been a pleasure.
Thank you.